Welcome to this morning's webinar. If you are joining us for the countdown to June 30th, Navigating Federal Student Loan Debt Relief, you are in the right place. So we're going to be talking today for about 45 minutes about what this adjustment is going to mean for you as a borrower, or if that's students that you work with, those borrowers as well. So we're going to be going through just some of the flexibilities that have changed. This was recently something that was just through April 30th, so we had just passed that, but they have extended it another month here, so we just wanted to make you aware of that. So just a few things before we do get started. My name is Beth Groves. I am a professional development specialist with the Illinois Student Assistance Commission. You may know us as ISAC. That is our acronym for short. So we are recording this session. We will have it shared on our ISAC PD page. Within a couple weeks, we have an on-demand webinars page where we post our recordings. So if you need to look back through any of the information, that will be shared for you there. If there's any kind of audio issues, there is a call me option to connect and see us on your screen, but you would be able to hear us through your phone instead. We do encourage you, if you have any questions throughout the presentation today, please do put them in our Q&A. It's located in the bottom right-hand corner of your screen. It's a little box with a question mark in it. That is where you can just drop questions. We will answer them live throughout. I have a couple colleagues on the line who will be able to do that for you. So please do feel free if you have any questions that pop up. We are not offering continuing education or professional development hours for this webinar, but we do have a survey that we would love for you to take at the end. So just to stick around for that if you are able to do so. So without further ado, let's go ahead and jump in. So if you are not familiar with ISAC, we are the state's financial aid and college access agency for the state of Illinois. So our mission statement is providing Illinois students with information and assistance to help make education beyond high school accessible and affordable. So we have all kinds of programs. Not only do we administer the MAP grant, we have scholarships, lots of programs for state teachers. There are a lot of programs that we administer specifically to Illinois students. But our team, specifically the team that I am on, provides professional development training. So what we do is what you're attending right now. We talk about loans, we talk about the financial aid process, the college going process, really anything that would be helpful to you as a college access professional or a borrower to learn to help your students or also for yourself as well. So that's just a little bit about who we are as a state agency if you, again, are not familiar with us. So here's our agenda for the day. We're going to talk about just a brief overview of what an income-driven repayment plan is. You will hear me refer to those as IDR plans for short. So what those are, what that means for this adjustment here. We'll then talk about what the IDR payment count adjustment is, who that is going to apply to in terms of loans, in terms of being an eligible borrower, and what that means for you. If you are somebody who is pursuing PSLF or public service loan forgiveness, we will talk about what that means for you, how this adjustment is going to change that, as well as if you have a consolidated loan. We'll get into some Q&A, just some common things that we've heard from people out in the field, from borrowers, and also just questions that the Department of Education has gotten. And so we'll go through just some of those commonly asked questions. But again, if you do have questions throughout the presentation, we highly encourage you to put those in that question mark box. It's located again in the bottom right hand corner of your screen. I do see we have a few more people that have joined us. So if you are looking again for that question and answer box, we will be able to answer those questions throughout the webinar with my colleagues on the line here as we go. So drop those questions in. Again, it's in the bottom right hand corner of your screen. And then we'll go through resources for you as a borrower. So let's get into those IDR plans. Just an overview of what is this, right? If you are, say, a new borrower, maybe you're entering repayment for the first time, or maybe you did enter repayment for the first time back in October after the end of the COVID-19 payment pause. So you might be wondering, what on earth is an IDR? Or maybe you have a good understanding, but you're wondering what this adjustment is going to do for you. So what an IDR plan does, again, it stands for Income-Driven Repayment Plan. So normally when you graduate, you enter repayment on the standard repayment plan, which is designed to pay off your loans within 10 years. That is great for some people, and it doesn't work out for other people, because if you're designed to pay it off within 10 years, you might have, say, a high loan amount, and that makes your monthly payments just not feasible. And so that might be something where you might want to look into an IDR plan. So what this is going to do is it's going to look at what your income is, as well as what your family size is. And that is going to set your payment amount at what is going to be affordable for you based on that information. This is information that gets revisited each year. You have to recertify. So this information will be updated with the Department of Education so that they'll be able to keep in mind what your family size and your income is to make sure that it's still affordable for you. So IDR plans, another nice thing about this is that yes, the repayment period is a little bit longer, but if there's a balance, say that you are in an IDR plan, you have a high balance of your loans, but maybe your income is a little bit lower, and so you have a lower monthly payment. If by the time you reach the end of that repayment period, the rest of that is going to get forgiven under an IDR plan. It's going to depend on the IDR plan. It's going to depend on what kind of loans you have. But it will get forgiven at the end of that. And that's kind of what this adjustment is helping borrowers reach. So IDR is also, we refer to it as an umbrella term. It is not a one size fits all. There are several plans underneath an IDR umbrella. So the pay as you earn is one of them. We have the payee as the acronym for that. Then there's the SAVE plan, which is fairly new. This came out of the Biden administration with just some of the COVID-19 debt relief. So this was, there have been some changes, some updates to it, but it replaces the repay plan. Then there's the income-based repayment plan, or the IBR, and then the income contingent repayment plan is the ICR. So this is, again, you're put on that standard plan automatically, so you will have to apply for an IDR plan if that's something that you want to enter into. So a good place to start if you're not sure which one you want to do, there is a help tool that will guide you through the process of what kind of repayment plan you should be on. But this is just a quick place to look as well. It's on the studentaid.gov website just to compare the different types of plans. So you'll see that it lists out the plan, it lists out what percentage of discretionary income. So that's going to be income that is after taxes, after any kind of necessary payments have been made to help you basically live. That's going to be your discretionary income. So you'll see that for most of these plans, it's about 10%. The IBR and the ICR are a little bit higher. And then you'll see that the repayment period is going to be dependent on for some of these SAVE plans specifically, if you have undergrad loans versus graduate professional loans. And then to look at the other plans, you'll see that the IBR again and the ICR are a little bit longer at the 25 years. But again, if you have a high loan balance and your IDR payment is going to be lower, that could happen for you where you reach that and you still have some loans to be forgiven. So it's good to look at what kind of plans are you eligible for. For some people, they might not be eligible for specific plans. They might need to potentially consolidate their loans, so something to look at as well. And then to know what are those repayment terms going to be under that plan for you as a borrower. So I mentioned recertification. This is exactly what this is. So you are essentially talking to the Department of Education. You are communicating with the IRS to have your income and family size updated yearly. So this is a pretty simple process to just go into studentaid.gov and do this to say that you are recertifying your IDR. You will either be able to grant consent to have the IRS transfer tax information just to recertify that that income and family size is indeed either the same or it has updated based on the information that they have from your taxes. Or if you choose to manually input that information or you're not able to transfer that information, you will have to upload some supporting documentation just to verify that that is indeed true. The nice thing too with IDRs is that yes, recertification happens every year. That does not mean that you have to wait until your recertification date happens. So during the payment pause, this was paused as well. Recertification did not have to happen, but that didn't mean that you couldn't recertify, especially if, say, there is a massive change in income, maybe there's a loss of a job, you would want to communicate that to the IRS. You would want to communicate that to the Department of Education to let them know that, hey, my income has changed, and so I no longer can afford these payments as a result of that change in income. Or say family size could be true as well. That may require some additional documentation just because it's not based on those taxes that you would have filed that had changed in between there, or potentially applications as well. But it is something that you do not have to wait, say if there is a change in circumstance. So consolidation, just as a brief overview of what that means, it's essentially combining all of your federal student loans. So it gives you one loan. So if you have maybe graduate loans and undergraduate loans, and you're worried about the fact that they're gonna take a little bit of a different time to pay those off, or maybe you're worried about the fact that your graduate loans have a high interest rate. That is something where consolidation could be an option for you. It does not necessarily mean that you have to do that. But if you are interested in having one payment, you're interested in having one fixed interest rate, what they're going to do with consolidation is that your interest rate will be the average of all the loans that you consolidate. But it's just going to be one fixed interest rate. So you no longer will have something at like 2% and something at 8%. You'll have the average of those. And then you'll have one lender as well, just to make it a little bit simpler on you. This is also something where you have to apply similar to the IDR plans. It's also a process that once it is complete, it cannot be reversed. There is an exception to that in that you get 10 days. You're going to get something called a summary statement. Once you have that summary statement, you have 10 days to cancel. If you decide you no longer want to move forward with consolidation, you can go ahead and say that. But once those 10 days have passed, you are no longer able to cancel that. It cannot be reversed. So it is just something to keep in mind if you are somebody who, say, is interested in consolidating, but maybe don't have to go through that process. The other thing with consolidation is that you will lose access to those lower interest rates after that consolidation. So again, you're taking the average of those loans. And so if you have a loan with a lower interest rate, you're going to get the average of that with maybe your loans with your higher interest rate. So you will lose access to those lower interest rates once you go through that consolidation process. There's a lot more information on consolidation on studentaid.gov just to kind of walk you through what that process will look like to move forward with that, again, if that is something that you're interested in or need to do for the purposes of the IDR adjustment. Okay, so let's get into what the IDR payment count adjustment is actually going to be. So with the IDR plans, we showed you that they have those repayment periods of 20 or 25 years, again, depending on what plan you're in, depending on what kind of loans that you have to be forgiven. What they noticed, though, is that a lot of periods of repayment were just simply not counting toward that time period of that 20 or 25 years. And so there were a lot of borrowers who were maybe close to that, but just hadn't quite reached that threshold. And so that's the purpose of this IDR account adjustment, is to make those changes so that borrowers can get a little bit closer to forgiveness by updating some of those payment counts. So they're being very flexible with what is going to count in terms of toward that adjustment, toward updating that payment amount. So that was in April of 2022. They've been working toward getting this updated just to more accurately reflect what's going on with the borrower's payment counts. It is currently underway. So this is something that was, again, initially you had to do these steps and consolidate if you needed to consolidate. We'll get into that by April 30th, but they've extended that now to June 30th, which is why we say countdown to June 30th. And so this is something that's still underway. So it's going to be going through September of 2024 with this new extension. It was something that would have been completed over the summer, but with the extension, they'll have it through September of 2024 to get those payment counts updated. If you are in an IDR plan or not, you are still going to be eligible for this adjustment. So who's it for? This is going to impact a few different people, and you'll see what I mean by it's going to impact you whether you're on an IDR plan or not. So it's going to impact you if you are on an IDR plan or if you were on one in the past. If you are somebody who is actively pursuing public service loan forgiveness or PSLF, or if you say are not currently on an IDR plan, but you're interested in being on one and you have direct loans, or if you have federal family education loans, or they're also known as FFEL loans. Those are going to count as well, as long as they are held by the Department of Education. So what they're going to do with this adjustment is that once you have those loans that have reached that 20 or 25 years, that's going to reach forgiveness, right? Even if that person is not currently on an IDR plan, because they could apply to be on an IDR plan. So borrowers that have loans that have that 20 or 25 years, that's going to be part of this adjustment as well, is that they're going to automatically see forgiveness, again, depending on what kind of loans that they have. So how is this going to work? So the Department of Ed is going through this in a strategic method here of going through certain people first. So the first thing is that they're looking at, okay, who's been in repayment long enough that they're likely going to qualify for income-driven repayment forgiveness, or that IDR account adjustment. So they're going to look at all of the borrowers that have at least one direct loan or one FFEL loan that's held by the Department of Education, and see what could be counted. And we'll talk about what payments are now going to count. And then what they're going to do, they're going to do the legwork for you, is that they will talk to your servicer. So if you're not sure who your servicer is, that's something that you can go to the studentaid.gov website and you can log in and see on your dashboard as who your servicer is. You'll want to make an account if you haven't done that already. And then they will instruct that servicer to update that payment count. So you can keep track of where you're at with that. So they have started with those loans that are have been in repayment for a long time. Then what they're going to do is they will look at borrowers who have an approved PSLF form. So this again is applying to those who are in that PSLF program to see what kind of months could qualify specifically for PSLF, because PSLF is also something that could bring someone to forgiveness, and a lot quicker than an IDR plan, right? That's a 10-year time to forgiveness if you're in public service. Then what they'll do is they will see what other loans are going to be eligible to update, to change that payment count adjustment to see what's going to qualify for IDR forgiveness. That doesn't necessarily mean that you're immediately going to receive that forgiveness, but it does mean that you are going to potentially get closer to that 20 or 25 years. So who's going to be eligible for this IDR account adjustment? So first of all, if you have a direct subsidized or unsubsidized loan, those are going to count. Those are going to be eligible for this adjustment. If you have a direct plus loan, if you have a direct consolidation loan, a direct parent plus loan, or if you have, again, a FFEL loan, that federal family education loan, that's owned by the Department of Education, those will be qualifying for this account adjustment. So they're going to look at all of those kinds of loans. That does not mean that if you have a different kind of loan, you're automatically not eligible. So specifically, if you have a commercially held FFEL loan, so it's not held by the Department of Education, or if you have a Perkins loan, or if you have a HEAL loan, the Health Education Assistance Loan, those will count as well, but you have to consolidate them into the direct loan program by June 30th of 2024. So this is that critical deadline here that we're trying to make sure that you all are aware of. Is that initially this was April 30th. So if you've already gone through this process as somebody who say needed to consolidate, then you're good to go. They're going to start working on that adjustment. But if you have not had the chance to do that yet and you need to consolidate, you will want to do that by June 30th of 2024, as this is already an extension. And so there's no guarantee that they'll make another extension. So for those loans, if they don't qualify, you'll want to consolidate so that you can benefit from this adjustment to get those into the direct loan program to qualify for that IDR adjustment. So what they're going to look at in terms of the payments that they're going to adjust, so they're going to look at any kind of payments that were any kind of months that you were in repayment, even if you were on, say, a different plan, even if you know, regardless of what kind of payment you made, regardless of what kind of loan type you had, they will look at that in terms of the adjustment. If you had 12 or more months of consecutive forbearance, or if you had 36 or more months of cumulative forbearance, so altogether, that will also be looked at here in terms of what they'll move forward with this adjustment. If you spent any months in economic hardship or military deferments in 2013 or later, those will count as well. Any months spent in deferment before 2013, however, this does not include in-school deferment. So we get that question a lot of, hey, I've been in school, I haven't been needing to pay on my loans. Is that something that's going to count? And the answer, unfortunately, is no, because in-school deferment still does not count for something like this. And then any time in repayment, or if it was deferment or forbearance, again, referring to those applicable moments of deferment or forbearance, if it was an earlier loan before consolidation, into that consolidated loan now. The other thing too is that they're still going to be looking at the period of time that we were in the COVID-19 payment pause, and be looking at that as a piece of adjustment as well. So what if you have multiple loans? The thing with multiple loans is that you might reach the forgiveness threshold at different times because maybe you took out one loan in undergrad and one loan in grad school. And so they're going to reach forgiveness at different times because you did that graduate school later. So just know that that is something to be considering when you potentially are thinking about consolidation, even if you don't need to consolidate. That could be a consideration, is that those loans might reach forgiveness at those different times, depending on what kind of loans you have. So if you get a loan forgiven or two loans forgiven, and you still have some left over, you might still see that on your studentaid.gov site or on your servicer's website as well. So just be patient with that in terms of seeing what gets forgiven and then what your balance would still be, to see after the adjustment kind of where you're sitting once they've taken everything into consideration. Okay, so we're going to get into public service loan forgiveness and consolidated loans. So if you're somebody who's pursuing PSLF, this is something to pay attention to, just to see how this is going to affect you. If you are not familiar with PSLF, just to give you an overview of what the program is, if maybe this is something that you are hearing about for the first time, but maybe you're in public service and maybe you want to see if you could potentially get into this program. So what this does, and I've kind of briefly mentioned this before, that this is a 10-year program. So it's going to forgive your balance on your loans quicker than an IDR plan would, if you're somebody who's, again, been in public service for those 10 years. So it's 120 payments, so that's 10 years of payments, right? 12 months, as long as you are under a qualifying repayment plan while you are working full-time for a qualifying employer. Now, they have gone through some changes with PSLF in terms of what counts as full-time, but they have recently just decided to agree on, okay, full-time is at least 30 hours per week. So it no longer has to be 40. It no longer is the multiple part-time jobs, qualifying. It's just 30 hours per week is now classified as full-time for a qualifying employer. So just note that that is a recent change with that. Now, the other thing is that it's only going to apply to periods of repayment after this October 1st, 2007 date, and that is because this is when the program started. So they can't consider payments that were made before that, and we get that question from borrowers sometimes is, I've been paying on my loan since 2005, but unfortunately those 2 years of payments are not going to count toward PSLF because the program didn't exist. They cannot give you forgiveness or cannot give you a payment account adjustment because that program didn't exist before. So it's only going to count to those October 1, 2007 payments and after that. So in terms of eligibility, you will have to have eligible direct loans. You again will have to be employed full-time, so that's that 30 hours or more per week. And that is by a few different options. So government is going to count here, whether that's at the federal level, state level, local, tribal, but also nonprofits, those 501c3s. So we get questions about the library. Yes, that counts. Public education. Yes, that counts. But the other thing is that there are some people who work at a nonprofit that's not a 501c3, and they have questions about whether or not that's going to count toward this. And the answer is it depends. And I know that that's not always the answer that everybody wants, but it does depend on whether or not you provide services to the public. So you will want to see kind of, if you think that you do provide services to the public, even though you're not at a 501c3, that is something to potentially look and see if you have an eligible employer. The other thing is making 120 qualifying payments. So that is the full amount that is repaying under either that standard plan or an IDR plan. Now, the thing with PSLF is that, yes, the standard plan is an acceptable repayment plan, but we encourage people to get onto an IDR plan because the standard repayment plan is something that's designed to pay you off within 10 years. And if the PSLF program is designed to get you forgiveness after 10 years, you will not have anything left to forgive. So just something to keep in mind if you are somebody who is looking into this and isn't really sure which plan to be on. Now, the application process, there is a PSLF help tool on the studentaid.gov website. That's where you can submit a PSLF application. It has gotten a lot easier to do this. The entire process can be completed online. Previously, you had to get wet signatures from employers, but now you can just go and send it to your employer to get an electronic signature, and it will all be processed online so much quicker. And once that has been signed and submitted, they will get transferred over to the PSLF servicer. So right now that is Mohila, but that just for your information, is being currently transferred back over to the Department of Education. So they will now house those loans. MOHELA will no longer do that. But currently, yes, it is MOHELA that is the PSLF servicer. So once those 120 qualifying payments have been made for PSLF, you'll get a notification that, hey, your balance has been forgiven. You no longer have student loans. So that is what the process looks like if you are interested in pursuing PSLF. Now, how this plays into the payment count adjustment is that you notice before, hey, they're looking at borrowers who have, they have an approved PSLF form, and so they're going to look and see what kind of adjustment could qualify for PSLF specifically. So they have started doing this, just automatic payment count adjustments for borrowers that had those eligible direct loans. Just know that as part of this process, if you are somebody who needs to consolidate or chooses to consolidate, you will likely see that your payment count temporarily resets to 0. This is just because this was part of the process of consolidation, and that previously, yes, it did reset your payment count to 0, and that was not a temporary thing. It is now a temporary thing, so just know that that is not something to be super alarmed by. They will fix it. Just know that you might temporarily see that that goes down to 0, and it's just part of the process of the consolidation. So PSLF is going to be they're going to continue to look at it each month until they have all of those IDR count adjustments done for those FFEL loans, for those direct loans. That will happen in late 2024, and that's also going to include those consolidated loans that were consolidated by that June 30th deadline. If you want to see where you're at with PSLF, if you want to see what your progress is looking like, right, you can use that PSLF help tool just to recertify that employment and see how many payments you're going to have that are eligible to reach that 120. So after that adjustment happens, you will see that anything that gets credited toward that IDR, if it's applicable to PSLF, it's also going to be applied to PSLF. So you might still reach that PSLF before you reach that IDR adjustment. So what about consolidated loans? So I was talking about before that if you consolidate, you're going to temporarily see it go down to 0 for your payments that have been made. So that used to be the process, and the current PSLF rules, they have gotten more flexible with it, is that now you'll see a weighted average of those payments. So if you have a borrower that's got 60 qualifying payments on a loan and they consolidate with another loan that has 0 payments, they're going to see their consolidated loan now has 30 payments. That is just PSLF in general. So it's gotten more flexible with that. But just know that right now, as a result of this IDR adjustment, if you go ahead and do this by that June 30th deadline, it's not going to be that weighted average. They're going to count all of those payments under this account adjustment. So if it happens after the fact, yes, you're going to see that weighted average, but just know that this is another piece of that flexibility, is that you won't have that weighted average, and it won't go to 0, maybe temporarily, yes, but you won't have it go down to that weighted average. You will see the full amount if you consolidate by that June 30th deadline. So we get questions sometimes about joint consolidation loans as well, and how that works, especially if you had a joint consolidation loan with a spouse previously, and maybe you are no longer with that spouse. So you're wondering, what do I do in terms of qualifying for this adjustment? So the Department of Ed, they are working on a process for loan separation. They won't have it fully implemented until late 2024 is what they've said. But just know that there is still an option for you to go through this process. You will have to do an application depending on whether that's joint or separate, and then you will have to do a new master promissory note. So this is just because it's essentially a new loan, and so you will have to sign it as you, the borrower, because it is now the loan in your name, and so you have to be saying that you are willing to repay that loan. That's the purpose of the new master promissory note. So whether you do this as a joint application or whether you do it as a separate application is going to depend on your situation. If you do a joint application, that is something where you're both going to request that separation of the joint debt. So both applicants will have to do that. If you do a separate application, say that you are no longer with that spouse, you don't have communication with that spouse, that's something where you could do this by yourself. You just have to do it as one borrower to request that loan separation, and it's just going to be for your portion of the debt. So now your spouse will have their portion of the debt as part of that consolidated, the joint consolidation loan. So again, this is still going to require that new master promissory note. And if you have questions, or if you want to just designate that you are intending to apply for loan separation, you'll want to talk with the Federal Student Aid Ombudsman group or your loan servicer, just to let them know that this is what you're thinking about doing, and they can help you answer any questions about what that process would look like for you. All right, I'm going to get into just some frequently asked questions that we get, again, from just being out in the field, but also from the Department of Ed has some frequently asked questions that they see from other people. So the question is, do you have to consolidate by the end of April 2024? That should say June 2024. Again, we are updating these presentations just for you all because this has been extended. So yes, June 2024, you do need to consolidate by that deadline if you have FFEL loans, Perkins loans, or HEAL loans. If you don't have those loans, you are not required to consolidate. That doesn't mean you might not want to, but it's not a requirement to do that by that June 30th, 2024 deadline. So if you do have those loans to benefit from this adjustment by June 2024, yes. So refunds, we get a question about refunds quite a bit, just about how that works in terms of receiving forgiveness. So it depends again. A lot of things with loans are going to be dependent. So if you have a loan that gets forgiveness, you might receive a refund for your overpayments. It's only going to count toward the loan that's forgiven. So if you've got a consolidation loan and you have overpayments on that loan specifically, that is what's going to get refunded to you, but not on individual loans specifically inside of that consolidation loan. Those are not going to count toward this. If you already received forgiveness, or if you already paid off your loans, not as a result of this IDR adjustment, that is not going to make you eligible for a refund of any prior repayments that went over repayment. You've already received forgiveness, but however, if you do receive forgiveness as a result of this, then yes, that is going to be something that potentially could qualify for a refund for your overpayment. What about taxes? So the nice thing with the state of Illinois is that the state of Illinois does not tax loan forgiveness. I don't know if you're joining from another state, but if you are in Illinois, just know that that is not something that's going to count against you. You also are not going to be taxed by the federal government, so they will not tax you for loan forgiveness as well. So if you are somebody who's living in Illinois, good news, you're not going to be taxed by Illinois or the federal government. If you are joining from another state, feel free to look into whether that is something that would be taxed in your state, to see if that is something that maybe you would want to opt out of if you're not looking to pay those taxes on it. Another piece is that with this federal tax liability, it's any debt, because there have been so many just times where we've been seeking loan forgiveness under the Biden administration. There have been a lot of programs put in place. So just know, because of this time frame of December 30th, 2020 to January 1st of 2026, if there's any debt forgiven because of some kind of payment count adjustment, that's not going to create some kind of federal tax liability for you. The other thing is that the Department of Ed, they are going to talk to you. They will let you know, hey, we are going to discharge your loans. You've reached forgiveness, yay, because of this payment count adjustment, and they will give you a period of time to opt out of automatic forgiveness. So if this is something where, say you are joining us from another state and your state is going to tax you, that is something where you could opt out. You could say, oh, the Department of Ed has notified me that I'm going to get this forgiven. And you have 30 days then to say, I don't actually want to do this. I want to just keep making those payments, because it could be that, hey, you have to pay taxes on more than maybe would get forgiven. So it's something to look into if you are joining us from, say, another state, or just choose that you don't want that to be forgiven. What about Parent Plus loans? So the Department of Ed, as part of this, you notice that the Parent Plus loans were included there for this IDR account adjustment. So Parent Plus loans will get forgiven, whether they are consolidated or not, as long as they have accumulated that 25 years worth of time in repayment. So that 25 years, because to be on an IDR plan for a Parent Plus loan, you have to be on the income contingent repayment plan, which is that 25 years. So they will automatically do that for all of those Parent Plus loans that have that 25 years. If you have a Parent Plus loan and as a result of that account adjustment, if it does not get forgiven because of that account adjustment or because of PSLF, what you'll want to do is you will want to consolidate that Parent Plus loan by that June 30th deadline. So this one's a little bit different than some of these other loans. But if you know that it's not going to reach that 25 years, if you know it has simply just not been that long, you will want to consolidate that and then continue to make payments under that income contingent repayment plan after you do that consolidation so that you can continue making that progress toward forgiveness. Now, default is another thing that we get questions about, especially after COVID and especially after some of these repayment plans that have been put into place to give people debt relief. So one of those is the Fresh Start Initiative. The Fresh Start Initiative is a couple years old at this point, but if you have a defaulted loan, you can get the benefits of that payment count adjustment if you get out of default using that Fresh Start program. So what this does is it gives you an opportunity to rehabilitate your loans. It's going to get you out of those issues with credit reporting. It's going to give you access to not only federal student aid, but also to loan forgiveness programs, also to different repayment plans. And so Fresh Start, if you're in default, is a great opportunity for you to get out of default and then to have access to some things that will help you move forward and not enter back into default. Now, Fresh Start is something that is going to end on September 30th. So I know everything's focused on April 30th, June 30th, September 30th. So September 30th is the deadline that you have to take advantage of the Fresh Start Initiative. If you are somebody who's in default, you can talk with the default resolution group about what your steps would be to get out of default if you want to take advantage of this program. So what about those joint consolidation loans? If you're worried about, say you have that loan and you're worried about getting that separation before the IDR adjustment happens, the nice thing is that the Department of Ed, they're going to retroactively provide that payment count adjustment to a borrower who eventually goes through that process. So once it's gone into that direct consolidation loan, even if that has happened after that June 30th, 2024 date, they are going to apply that benefit retroactively for you as the borrower. So that is a nice flexibility with this as well. All right, we have just a few more minutes and I'm going to go through some resources for you all. So these are the current Department of Education held loan servicers. So again, if you're not sure who your loan servicer is, you can go to your studentaid.gov account just to look into this information. These are going to be some of the names that you might see pop up. Again, Mohila is currently the PSLF servicer. So if you are somebody who's pursuing PSLF, that's going to be who your loan servicer is. This is what your loan servicer's website is going to look like. So we just wanted to show you Mohila specifically. One thing that I like about this is it will have this little emblem that says official servicer of federal student aid so that you know you're not on a scam website, you're in the right place. And this is where you'll have to create a login if you haven't done so already, but you can keep track of your payments. You can make your payments, but it also just has a lot of other information for you as a borrower. If you have questions throughout the process, it's not just a place to go to make your payments. So if you're not sure who your loan servicer is, I mentioned that you can go to studentaid.gov. This is where you'll log in with your FSA ID. That's just your login information. If you've ever filled out a FAFSA, that's the same information that you'll use to log in. This is also where you would go to recertify your IDR, your IDR plan. But this is where you can go to look on your dashboard to see who that servicer would be. Now, FSA has a loan simulator, and I love this tool because it can really help borrowers figure out what they should be doing in terms of repayment. So the first thing that you could do is you could either log in with that, again, FSA ID to start, and they would pull all the information from the loans that they know you have to start, or you can start from scratch if you want to just estimate to figure out what your best repayment strategy is. So this is going to be dependent on whether or not you have loans that you want to pay off really fast, or if you want to count for public service loan forgiveness. It's going to guide you through what the best strategy will be. It's also a place to see what to do if you are struggling with those loan payments, to see what your options are, maybe a different plan, maybe if you're on a standard plan to get on an IDR plan if you're struggling, but also to simulate borrowing more, say if you want to go back to school, to see what that would look like. ISAC has several resources as well. So we have information about the one-time payment count adjustment. We have resources about that, but we also have information for other forgiveness programs. We are hosting webinars throughout June, just to make you aware of this. So if you've got coworkers that you think would benefit from hearing this information, pass it along. We have one on the 11th coming up, as well as the 20th. The 11th is going to be more Q&A focused, so you'll be able to get questions answered throughout that, instead of having a lengthier presentation. If you are somebody who has seen that there might be an error, say with your account adjustment, or maybe there's a scam that you've run into, there is an option to submit a complaint that the Department of Ed has just specifically designated a feedback center for that. If you run into that, if you feel like there's an error, you can submit a complaint now on their feedback center, which is really helpful for borrowers. Speaking of scams, please beware of scammers. They are everywhere. Anywhere there's money involved, they are going to be. So if you have somebody who's talking to you about debt relief, loan forgiveness, and they are promising it, run away. They're going to try to look real. They're going to try to have an official looking information. So just know that there are some things you can do to avoid running into scammers, and just how to spot them. So if you know that you can receive this help for free, ISAC has free services to help you avoid it, right? If they're making you pay, then that is something that you want to run away from. If they want a monthly fee and upfront cost, if they have immediate loan forgiveness as a promise, or if they're asking you to share your FSA ID, again, that's your login for studentaid.gov. That's going to have a lot of really personal information. We will never ask for that. The Department of Education will never ask for that. So do not share that information with anyone. If they're asking for that, report it to the Department of Ed under that complaint form. All right, the moment you've been waiting for. So again, we are not offering continuing education or professional development hours specifically for this webinar, just because it is geared toward borrowers, as learning about this for yourself. So please do submit an evaluation, even though it's not for those hours, just to provide feedback for how we did today, as well as just information that maybe you would like to hear in further sessions. Please do fill that out by 4:30 on Friday, May 31st. My colleague Tommy just went and put it in the chat. Again, the chat is located similarly to where the Q&A was, in the bottom right-hand corner of your screen. There's a little like text messaging option. So you will see that there as well. So you can access, again, the evaluation there. And thanks so much for joining us this morning. If you have other questions, we encourage you to email us at isac.borrowersupport@illinois.gov. Again, we are not, we can't certify your employment for PSLF. We don't want you to send that information to us. But if you have questions about the process in terms of federal student loan repayment, we are there to help you. We just can't certify that kind of information. So again, thanks so much for joining us on this Wednesday morning, and enjoy the rest of your day.